Welcome into another Tax Talker. Today we have a back to basics on payroll taxes and self-employment taxes. A very confusing part of tax law to business owners, very frustrating for the new business owner. Let's get into it, unpack what they are, how an S corporation may be able to mitigate your exposure. Let's talk about it. Start with what payroll taxes are. You've been paying them since you had your very first W-2 at the McDonald's, like I did. You paid someone called FICA and Medicare 7.65% of your wage. FICA, that's Social Security. You're paying into the Social Security system at 6.2% of your wages, and Medicare at 1.45% for a total of 7.65. That comes out of your paycheck regardless of whether you're subjected to income tax or have any income tax withholding. Important here to understand before we get into self-employment tax is your employer is matching that. Behind the scenes, they're holding back that 7.65%, and then they're matching it with 7.65 of their own dollars. So the government gets 15.3% paid in to the FICA and Medicare system based on your gross wage. The FICA limit does max out at a certain point. It gets bumped every year based on inflation, but you can only have so much Social Security benefits, so you also cap in how much you can pay into that system. It's roughly 160, 170,000 of wages. It'll just stop at that 6.2. Medicare goes the other way. For top earners, you actually get a surcharge put on. It comes to closer to 2.3% at high income levels. But on that first 160-some thousand of wages, you're going to be paying 7.65, and your employer's going to be matching that as well, 15.3%. Moving over to self-employment taxes, no one's paying into that system on your behalf when you're just earning money as a self-employed person. Personal return has a form for that. Schedule SE takes into account self-employment income and then subjects it to self-employment tax. And that's basically 15.3%. It's a little bit more complicated than that, but that's roughly what it is. For a sole proprietor reporting their income on Schedule C, all of their Schedule C income, their net income, is going to be subject to self-employment taxes, as well as be part of the income tax. So it really is the same as payroll tax, and it's paying into the same system. It's just administered and collected differently. It's done through your personal tax return. For first-time small business owners, this can come as a very big surprise if you're not prepared for it, because it's essentially just a 15% kind of flat tax on your income, at least the first 160-some thousand of it. And then on top of that, you're paying in normal income taxes based on the rest of your income. And so this is the part where you say, well, no, I'll just become an LLC and not pay self-employment taxes, right? No, wrong. You didn't watch my last video, so go back and watch that. An LLC is not a tax status. What you can do is elect to be an S corporation. And what an S corporation does is you're basically opting into an employee and employer relationship with yourself. You start an S Corp and could have no other employees, but you will have to have payroll to pay yourself. You will pay yourself a wage, you'll give yourself a W-2, and that will all be subject to normal payroll taxes. But what's significant here is you set your salary, and then any profits after that are going to pass through to you on the S corporation return, to your personal return, but not be on Schedule SC. Those net profits are not subject to self-employment tax. So this is the big significance of the S corporation. You're limiting how much of your profit is exposed to that basically 15% cut on the self-employment tax. So in very round numbers, if your net income on this business is 150 grand, well, you're gonna be paying 23,000 in self-employment taxes on a Schedule C. If instead you elect S status and you pay yourself a W-2 of say $75,000, well, you've just cut your self-employment tax burden roughly in half. So you're gonna be saving somewhere between 10 to 12,000. Now, the S corporation does come with additional compliance burden. Filing those returns are usually more expensive than just filing your personal return, and on top of that, you also have to pay for payroll, and payroll is a big headache too. So you want to make sure it's done properly. If you're just making a few thousand on a Schedule C, it certainly wouldn't be worth all the extra effort. You're going to run the gambit on the internet of where at you start to break even. What I would tell you is it really depends on how much hassle you want to bear. If you're willing to bear the costs in terms of spending your time to pay for a very cheap payroll service and maybe self-prepare or use an online service to prepare your S corporation very cheaply, well, you have increased the amount of demand on your time, but as long as you're good with that trade-off, well, then an S corporation makes sense, maybe at 50,000 of net income, if that. On the flip side, if you're looking to pay a reputable payroll service and get good service for that, if you have a CPA, it's more, the break-even's more like 150,000 in net income. When we see this trade-off everywhere, it's just how much are you willing to bear the cost with what you will spend in your time and hassle and some risk of messing up payroll, and then you got to go back and actually pay someone way more money to undo the mess you've made. But if that's not an issue, then yeah, an S corporation can start saving you quite a bit of money very early on, even if there's not a whole lot of total net income. The other elephant in the room here is that compensation number. If you were paying attention closely, you might say, well, why would I pay myself anything? If I just don't pay myself a W-2, then there's no payroll taxes and just let everything flow through. It's just the law that if you have an S-Corp, you have to pay the owners a reasonable salary for the services they're providing that business. So it's not really an option to just not do it. You would quickly get a tax notice on that. There's also just practical reasons you don't want to keep your salary too low. You're not going to be able to contribute to retirement. You're not going to be paying in anything to the Social Security system. So there are just other practical problems if you just keep that salary ridiculously low for a long period of time. Where the gray area comes in is how much should that salary be? The IRS will use the term reasonable compensation. And this is taken to mean based on the facts and circumstances of your business. You can take into account any number of things, like the industry you're in, the time you're spending, your role, your duties. Two best starting points that I tell clients is, well, what would you have to pay someone to do what you're doing for your business? And two, what would you get paid if you went out into the marketplace and just got hired as an employee somewhere doing what you do now? Those are kind of two good starting points for your wage. Those can be difficult because if you're just starting out, well, both those things probably have a higher answer as reasonable pay yourself because you're just starting out. So we need to take into account what the business is actually making, the profits of the business as well. There is no hard formula, and if anyone online is telling you this is a surefire way to pay yourself a very little amount of money, they're not right about that. There's just a more aggressive approach and a less aggressive, and an aggressive approach where you have more support or not. The bottom line is there's nothing sketchy about an S corporation. It is a very straightforward way to legitimately limit your exposure to self-employment tax / payroll tax. You can think of those interchangeably when we're talking about this topic. But the actual savings is really going to depend on total profit and what you can legitimately call a reasonable salary to you from that profit, and then let the rest flow to you self-employment tax free. So that is the basics on payroll tax, self-employment tax, and why S corporations impact this so much. If you found this helpful, be sure to like, subscribe, leave a comment, and we'll see you next time.